Service. Okay, I'd like to call the meeting of the Food Service Committee to order and request if there is approval of the minutes of the last meeting.
I move we approve. I didn't see any problems.
Okay.
I'll second that.
All in
Second.
favor? Aye.
Aye.
Excellent.
Aye.
Perfect. There is one pension, and I don't know if we have. Is
Yeah, Jerry's on.
Jerry's on?
I am here, Frank. How are you?
Very well, Jerry. You want to
Good.
go over
Okay,
this
we do
one
have the-
pension?
We do have the one food service pension application to submit this evening on behalf of Magdalena Jimenez. She is 79, so she is getting a regular pension. She elected the standard option, and her monthly benefit will be $659.91, annualized to $7,918.92.
I'm glad you mentioned the idea that, by the way, that she is 79. My hat's off to her. And is there any discussion on this pension, or is there a motion to accept,
I move to accept or move to approve.
approve?
I'll second that.
Second, all in favor? Aye.
Aye.
Opposed? No. Passes unanimous. Is there any other motions, like for adjournment?
Move to adjourn.
I'll second that.
All in favor? Aye.
Aye.
Thank you very much. Moving on, we're going to begin. I'd like to call to order the regular pension board meeting and request approval of the minutes.
I'll motion to approve. No comments.
No comments. Second, even though we weren't there, all in favor? I'll
Aye.
second. Aye. Excellent. By the way, I do want to thank Jim for leading the meeting in November.
It was a very short meeting with no quorum.
Yeah. Well, I had called in advance that I did have a commitment that was like 10 days in advance. So, you know, it was like what I had to do. Is there any public comment? Oh, wait, before that, minutes, the approval of the minutes. One of the things I would like, it did say that you approved a calendar in November.
Yep.
Yep, and I'd like to have the calendar added to the minutes, because I don't know what the calendar is. So whoever adjusts the minutes, if they could please add the calendar to the minutes. Is somebody out there? I guess, I don't know. Okay, with that addition, approval of the minutes.
Britt, do you have the calendar, or was that, who provided that?
Yeah, Helen sent it to me after the meeting. I can forward it to you, Frank, if that would be helpful.
Okay, thanks.
Yeah, I guess the reason why I'd like it in the minutes is if somebody, I am trying to get some other people onto the board. And then they would, what that is, because I recommend that they read some of the minutes from previous meetings. That's why, but I would appreciate it if you sent it to me.
Yeah, I will reply to Helen as well and ask her to update the minutes and include that too.
Okay, excellent. Thank you.
Could you
Is there
send
any-
the minutes of the calendar to me as well, please?
Yes, I'll distribute to the whole board after the meeting.
All right, thank you very much.
Thank you, Britt. Is there any public comment? If there's no public comment, we're going to move on to pension applications. We got Jerry there again.
Okay, we have two pension applications to submit this evening. The first one is on behalf of Nancy Stewart with the Board of Education. She's 67, so she's eligible for a regular pension. She elected the standard form of payment, and her monthly pension is $923.88, annualized to $11,086.56. The second one is on behalf of Lawrence Taylor with the Department of Public Works. He's 57, so he would be getting an early pension. He also elected the standard form of payment. His monthly benefit is $1,909.93, annualized to $22,919.16.
Is there any discussion?
I didn't see any problems, so I move we approve both.
Well, there is one, there is one thing.
No.
Oh, no,
Yeah.
no, wait.
Okay.
Now, I'm a little reluctant because this is recorded, because in a meeting I would say this, but so I have two sets of twins. And one of the things I used to joke about is that the only thing they agreed on is that I treated the other one better,
Of course.
right? So Nancy Stewart, if you read this, she has a set of twins.
Yep.
Okay? And one of them is getting, in the event that it goes to her children, one is getting 33%, the other's getting 34%. So
Yep. And it
mom, like,
wasn't, and it wasn't the firstborn.
and that's right. And it could have been the firstborn, could have gotten 34, and each of the twins got 33, but that's her decision. And I'm sure that one of them might say, Mom likes you better. Anyways, I just thought that was kind of a fun little,
Didn't see that very good.
Well, they probably
Yeah.
wouldn't have known that, Frank, if you hadn't done that in the meeting, and now it'll be on YouTube.
I know, I'm gonna be comments on it, oh God. Anyways,
Anyway,
I
still-
second.
Okay.
okay, all in favor?
Uh,
Opposed, they all pass unanimous. Excellent. Thank you very much, Jerry.
You're very welcome, Frank.
You have a good holiday, Christmas, okay?
And you
Um,
do the same to everybody.
Happy New Year.
Okay, international equity management discussion. Is this, we're gonna go into executive session?
Right. And there's a different link for this, correct, or?
Yeah.
Yeah, there is. Did everyone get it? Do you want me to forward that to everyone again?
I
I-
got it. too.
I got it.
Okay.
You can find the right one here.
Right.
Yep.
I mean, we did in the past, we did go into an executive session off of this link.
I'm leaving to join. That's
Yeah,
what it says.
you'll have to
Click it.
leave here to join over there.
Let me make sure I got the other link before we do that. So this one came from Chitsamy.
This one
I
came from
believe- I
Pittsburgh,
believe so, yes.
Let me find it. I have
and
it.
it was on,
Yes,
It was on the
Tiffany sent
12th of December and it's titled Executive Session Zoom Meeting.
right,
yeah, she sent it Monday at 11 o'clock, 11:01.
Yeah.
All right, should we go there now?
Yes.
yes,
you can
so we're gonna go
over
into
there now, yep.
executive session now.
Yep.
Okay, I'll meet everybody on the other side.
Sounds good.
Okay. Leave this meeting. take the money from Artisan.
Sorry, I
Um,
just started the recording.
Okay,
You want to,
start.
because we have to actually go and move the money from Artisan, right, into Walter Scott. So is there a motion for that?
All right, I'll move that we move our current investment with Artisan Trust to Walter Scott.
Is there a second for that?
Second,
All in favor?
Aye.
Aye. Opposed? No. Thank you very much. Performance review.
Great. Does everyone have the October flash report?
Yep.
Perfect. So I'll start on page 3 of the PDF showing the asset distribution. Assets are about 450.3 million at the end of the month. You can see total equity slightly underweight, largely due to international equity, about 20% versus a 23% target. Blackstone, as I mentioned, made distribution of about 4.7 million in October. We expect those to continue quarterly. One question for the board is we are prepared to discuss global equity long-short candidates in January if desired. Wanted to get your thoughts on bringing that to next month's agenda, if that's reasonable.
This would be to discuss the managers or what?
Just to discuss potential replacements for Blackstone.
Okay.
And the other decision is if you want to continue with such a large allocation to this asset class. I guess that maybe that's a broader discussion. Certainly have no issues with ABS. But the asset allocation could be tweaked alternatively as well.
Should we have that discussion first, or should we see what our choices are? And that's one of our choices, none of the above.
Well, we can have them in conjunction with each other as well. I
Okay.
think from Callan's perspective, we've identified potential candidates that we think might be reasonable, and maybe we have both of those next month and we can come to a conclusion on how to move forward.
Yeah, I'm okay with that.
Yeah, I agree. Let's see how
Great.
the asset class is doing overall and go from there.
Okay, great. The other underweight is fixed income. As you all know, rising interest rates have detracted from the principal values within fixed income, and PIMCO's overweight slightly. I also wanted, Frank, I don't know if you want to discuss cash now for benefits or wait until after we're done the performance review.
Oh, we could get, Chitsame, would you like to talk about the cash? What your needs are, if any?
Of course. Right now, our available cash is about 5 million. We're gonna draw down 3.5 to pay this month's benefit payments. So that leaves us about 1.5. So my request is to, a cash need of approximately 10 million to get me through the first quarter of the calendar year 2023.
Chitsame is 3.5, that's higher than
Correct.
normal.
We had a few of the drop payments. These are deferred pension plans for police and fire. So we did get an estimate that, for December and January, a lot of them are redeeming these drop payments that we have to pay out.
But that'll end after December, January. There will, this number of 3.5 will come back down to roughly 2.5 or so in
Well, it'll
February.
come back down to more of
2.6,
2,
Okay,
2.8, 2.9, so.
so we could be at, towards the end of this year, we could average about 3 million a month.
Mhm.
Okay. Okay, so 10 million. Anybody got an idea where we're gonna get it?
Do have a proposal prepared if you, I'd like to share my screen if that's all right, Frank.
That would be perfect.
Everyone see
Yep.
So we have the October balances on the left here, and as I mentioned, we're slightly underweight equities. November was another positive month for equities. We are overweight PIMCO. And from our standpoint, the BlackRock Russell 1000 and the PIMCO All Asset are the best places to take it from at this point. While we see the underweights and overweights here on the right side of the screen, I think one way to help put it in perspective is to lower the cash amount to something that might be more realistic as benefits are paid. And you can see if I reduce that to about 4 million, slightly underweight continues to equity. You maintain an overweight to PIMCO and an overweight to UBS. UBS is quarterly liquidity with 90 days notice. So like some of the hedge funds, other hedge funds, it's about 6 months to get cash from there, and they've performed very well in the volatility that we've seen over the last year. And ultimately, I think it really maintains the current asset allocation if you withdraw from the BlackRock Russell 1000 and the PIMCO funds.
Does anybody have any questions or discussion?
Yep, seems reasonable.
Yeah, I agree. Looks reasonable.
Yep.
Same here.
Yep. Okay, so,
Britt, I just want to mention, I know that we're still gonna get the quarterly drawdown, I believe, is that from Blackstone?
It
Yes.
is.
So that's about 4.7 million.
And
that
that's
comes-
in February, is that right?
you said that you got it in October, right? Wasn't it the last one in October?
Yes.
So I think
So
the
it'd be
next
in-
one is at the end of February. So we
Well,
could,
there's, wouldn't it be in January? If it's
Mhm.
October, 3 months later?
end of January, correct? The last day of January, first day of February.
Was that in your 10, Chitsumi?
But well, I just need a total of 10. Right now I have 1.5 million
So
available.
could potentially reduce these to $3 million redemptions each.
Right,
And we can confirm in January that Blackstone will be providing the redemption at the end of January. And if not, we can make another recommendation next month if absolutely necessary.
Yep.
Yeah, sounds good.
Yeah, let's
no,
do that.
right, that works. Is that
Okay.
okay with you, Chitsame?
Yeah, that's fine.
Okay,
So we'll do 3 and 3.
I guess, do we need a motion for that?
Yes.
The motion,
Yeah, I move we take 3 million from BlackRock and 3 million from PIMCO to fund cash needs in 2023.
and is there a second to that?
Second.
And is there a discussion? Nope. Okay, good. All in favor?
Aye.
Opposed? Nope. Passes unanimous. Perfect. Thank you.
Great.
Thank you, Chitsame.
Yeah, thank you, Chitsme, for that reminder.
Yes. Performance review, you want to continue on?
I will. On page 4 of the PDF, we show fiscal year to date performance, which is just about 4 months and then longer term. Within domestic equity, your active managers continue to perform extremely well. You can see LSV up about 1.3% fiscal year to date and over 10% over the trailing years. So it's great to see their style come back into favor and them outperform after struggling in the growth cycle that we saw previously. Columbus Circle continues to do well versus their benchmark, and longer term returns have been great. Within international equity, Artisan has rebounded, and their quality bias has certainly helped them on a relative basis. You can see outperforming pretty significantly on the short term, but longer term returns continue to lag the benchmark. Silchester has struggled a little bit in this market environment. But longer term, we continue to have faith in their process and team, and returns continue to be good. Within global equity long short, it's been a very difficult market environment for these managers. You can see both Blackstone and ABS were negative for the fiscal year to date. ABS has certainly performed much better over the trailing 12 months and longer term. And those returns are more in line with where we'd expect them, providing some protection versus long only equity, but continues to be a difficult part of the market to outperform. On the last page, showing fixed income, as you know, in this interest rate environment, Core Plus in particular, which tends to invest in outside the benchmark riskier fixed income sectors such as high yield emerging market debt, which over the long term tend to provide strong performance. They've really detracted over the last year. You can see that playing out in particular in MetWest, and most of that is a slightly longer duration positioning, which has not helped. And they are invested in mortgage-backed securities, which have certainly been one of the worst performing sectors within US fixed income. And then finally, UBS, your absolute return manager, which really seeks to provide positive performance in any market environment, and very encouraging to see over the trailing year up over 5%, where we've seen equities down close to 20%. And then finally, PIMCO, we've seen negative performance, but in line with expectations. The TIPS index, while it's technically the benchmark, is not really a realistic benchmark for them, given their equity exposures and some of their global fixed income exposures. So longer term, they continue to do well. And you can see the total fund down about 1.4% fiscal year to date, which doesn't include private equity, given the lag in performance, and longer term performance is more positive. Happy to answer any questions.
This is kind of a non sequitur, but one thing I really would want out of the global long short that we're going to look at, I understand that we get some diversification and some volatility benefit from those funds. Now, I'd really like to focus on really getting our bang for the buck, or is it just an academic argument?
Yeah,
And maybe we look at doing looking at another absolute return manager as an alternative for those funds.
Yeah.
See,
Yeah, I mean, we're not obligated to have any specific, area to fund the pension. And, you may well be right. I mean, it doesn't seem like they've done very well. I mean, look, we got really burnt in, in Blackstone, I think. So, that could be part of the discussion, really, whether we decide to continue with that asset class.
yeah,
Yeah,
go ahead, Jim.
I was looking at the same thing when Rich brought that up, because I was just sitting here looking at the Russell 3000, versus the hedge fund index up there, and it doesn't look like it's doing its job.
The one thing I remember from my days of at 0.72 is you'd have the argument, you're not beating the S&P, but we were getting similar returns with a Sharpe of 2 rather than 18, and so you're getting something for it.
Yeah.
And I just wanted to see if we're getting something for it or not. If we're I'm okay giving up a little bit of return if it lowers our overall volatility. But if it's not, what are we doing?
Right.
especially for the
didn't-
fees.
Right, it didn't really seem like, I mean, it didn't. I don't disagree with you. It doesn't seem like it performed the way we anticipated.
Yep.
You know, and, you know, if we feel that, you know, I mean, do we look at the market here and think, well, you know, rates might, I mean, the Fed met today. This bond market rallied even after the Fed discussed things, and, you know, could the stock market or some other field, some other place, would we be better off investing this money?
And next month, we can bring our hedge fund team on, and they have a much closer view of what the global equity long short universe is, and it's not big. And I think there's a reason for it. And I think they're good.
Not big, it doesn't get, it
Oh,
isn't
yeah,
getting bigger.
Why is it not big?
Well, I think it's very tough to deliver. And I think you, Rich, you certainly know that from your days sorting stocks is not a profitable business for anyone. But I think getting a broader view on the market and what they're seeing and how they're seeing these managers broadly perform will be helpful context to the discussion.
Yeah, I mean, I'd be happy if some is, you know, you don't necessarily need to short individual stocks. You can go and you know, don't necessarily need alpha from being short something. If you want to run a net book of you know, 50 to net long 50 to 70% using ETFs, you know, that's okay with me. You have some room to swing there, but you know, I'm not seeing I'd be interested to see what the data shows on how much reduction in volatility we're getting, how much risk reduction we're getting for our lower return.
Yeah, I mean, I would look at this and say, I would expect, yeah, I generally look at hedge fund performance, and I expect it to, you know, not get the ups or the downs that regular equities get, but that's not what seems to be happening here. They seem to be underperforming on the upside and kind of matching on the downside. You know, so
20% to boot.
Right,
yeah, right.
yeah,
And if we blow up, we give you your money back.
Right.
Yeah.
What's left of it.
yeah, over time,
It's not, we don't rebate our performance fees.
you know.
Well, I guess the question is, has the industry evolved? You know, there's some things going on in the industry that it's different than it was 5, 6, 7 years ago. That's, I guess, what I'm kind of wondering about. So yeah, Brett, I think it'd be a good idea to have that team come in, Brett, and get their views.
But one of the things is a team coming in that they're obviously not going to like be the ones who say, yeah, this isn't really a very good field to be in. You know, I mean,
You know, I trust our ability to be skeptical, Frank, though.
well, I know. I think that's unanimous on the four of us who are here. And I think Eileen would be probably in agreement with that too. Yeah, okay. And it's Britt who's going to have to explain to his team that these guys are like ruthless.
No, I will, there's nothing wrong with giving a independent, practical opinion and not painting a rosier picture than needs to be painted.
Excellent.
Yep, good. Let's hear what they have to say.
Any other questions about performance? If not, is there anything else anybody would like to discuss, or else we could adjourn?
We got OPEB to come, right?
Yep, we have OPEB to come. We have to,
Move
Okay,
to
sir.
adjourn, move to adjourn.
a second.
Second,
Any discussion? No, all in favor? Aye. Opposed? Excellent. Thank you very much. Meeting is adjourned, and we're going to move on to OPEB. I'd like to call the OPEB meeting to order and approval of the minutes from the last meeting.
Motion to approve.
Is there a second? All in favor?
Aye.
Is there any public comment? Since there is no public comment, we'll go on with OPEB asset allocation review.
Right, so we have Rick Ford from Callan's Capital Markets Research Group on. Hey, Rick. So as you know, we revisit the asset allocation of both the pension and OPEB about every 3 years. And on the work plan for 2022 was to make sure that the current asset allocation meets the needs of the liabilities and really is still sound. So like we've done in the past, Rick's going to walk us through a high-level overview of where the OPEB is today. And, you know, obviously the liabilities are changing a little bit as this plan matures. And Rick will walk us through the analysis.
Thanks, Brick. Just want to do a quick time check. You know, I can talk about this all day long, and after
No,
this
you
meeting-
can't.
after this meeting, I'm going home for a break. My wife would prefer that you take a lot of my time here. So about 10 minutes or so. It
10
looks
minutes that's 10 minutes is perfect.
perfect. All right. Well, you know what? I'm just going to throw it up on the screen here just so that we all have it. It's right in front of us here. So, okay. So let's just go to, all right. So, what are we trying to accomplish today, right? We have your current asset allocation, what we're going to call, 80% equities and liquid real and 20% core fixed income, right? That's been the allocation for a while. My understanding is the committee's comfortable with it. So we want to make sure we look at this in the context of the liabilities and just make sure that it's sufficient going forward. And if we can make things a little bit better, great. If things are going to be fine, then we'll just leave it as is. So the 930 assets are about $110 million over a 10-year period, which is our standard forecast period. This allocation based on our mid-year market update is assumed to earn 6.6%, and your discount rate is 6.5. So inflation's 2.5, and your actuary uses 2.6. So good news, everything is really aligned here. And what we've seen over the last probably 2 or 3 years in the public sector space is that the discount rates have been hovering well above what we think the 10-year return is going to be. So there's been a lot of actuaries going into meetings saying you have to lower your discount rate. And we've seen that trend over time, and I think we're at a point where hopefully we're going to see a pause in that action. So it doesn't mean you want to raise your discount rate necessarily, but I think going forward over the next 10 years, you're looking good from having all your assumptions lined up properly. So the spoiler alert, I'll just get to it, is we recommend no change to the policy. Okay, 80% equities and is about equities and alternatives is about as high as we allow our clients to go. You've been there. The reality of it is that you've taken on all the pain this year, right? And so there's no real reason to diversify your way out of that. Right, let's give the markets a chance to recover. There's a lot of people saying there's a small chance of recession, maybe in 2023, but the reality of it is you've survived it very, very well. And the impact of these investment results don't get felt on your contributions for about another 3 years, and we'll walk through the timing of that a little bit later. So the most recent valuation we have is June 30th. So this was the starting point of our analysis. Market value of assets is 140, so we're down 30 million from then. That's both capital market depreciation as well as benefit payments going out the door. That was offset by employer contribution. So you put put $10 million into the trust last year. And then going forward for the next 2 years, we expect $2.5 million coming out of the trust. So first thing first takeaway is your benefit payments are going to be greater than $2.5 million next year. So on a quarterly basis, we're going to be needing to raise cash to pay for benefit payments. So one of the things that we do recommend is you allocate, a couple percent to cash along the way, and you use the cash as well as these meetings to trim back from the managers that have done well to raise the cash, and that'll keep you within your asset allocation targets going forward.
One thing, Chitsame, if I could ask, Chitsame, we haven't drawn out of this fund yet, have we?
No,
So we don't know when, I mean, we don't know that we're going to be drawing out of this fund, do we? Yeah.
Okay.
well, we actually, because of the lower contribution in fiscal year 23-24, which we're in fiscal year 23 now. I did talk to Britt earlier this week regarding a cash need to fund the benefit payments. And I did mention that, we run about $1 million a month to pay these post-employment type of benefit. So my request for 6 months would be $6 million of cash drawdown.
So Frank, I think the difference is in the past, we never had to raise cash because the city's contribution covered all of the benefit payments going out. So it really wasn't a part of this committee's need to raise cash. But given the valuation that's rolled forward, you can see the employer contributions is being reduced pretty significantly this year and next year. And that difference is where we're going to have to raise cash to pay
Right.
benefits.
Yeah, I mean, I actually never knew we were actually drawing money down from this fund. We never discussed that. I know that, OPEB was started, I think before 2010, and I know that they talked about starting to withdraw at some level, but so the thing is, when Chitsame, when we talk about withdrawing funds in the future, perhaps it could be like we could discuss what we're drawing from the regular pension plan and then also from the OPEB plan. Does that seem reasonable to everybody? To Chitsame?
Yes.
Chitsame, do you know what's behind the drop in the city's contribution?
Well, we currently contribute 2.5. Is there?
But it had been 10.
Yeah.
Correct, yes, we have been 10 just to keep funding the this OPEB trust fund. And right now, I think we're at 90% funded.
Okay. So it's funded up, that's all. Got it.
Yeah, Jim, to answer your question, on page 8 of the presentation, this is direct from the CAFMAC actuarial report. So the unfunded liability is the difference between the liability of the plan and the actuarial value of assets, which is a smooth asset value. So it's designed to be a little bit less than market when markets have gone up and greater than market when markets are bad. That way you, that takes the market fluctuations out of it.
Yep, smooth it out.
Right. So that unfunded is brought in over a 10-year period. And in 2019, the unfunded was $50 million. So the amortization piece was about $6.5 million. We had great market performance over a 2-year period, and the unfunded went from 50 down to 4.5. So then the amortization of the unfunded went from 6.5 down to $500,000.
Got
So
it.
that-
Yep.
Yeah, but also they look at the actuarial accrued liability. It's $20 million lower. Didn't they change?
They changed
Some-
the
Yeah,
medical plan.
Yeah, there you go.
And the changing of the medical
Medical
plan
plan.
bumped us up substantially.
Yeah, that
As far as the fund.
that was the big difference.
That's right.
Yep.
Barron did that. And that move in the money, that was what really changes quite a bit.
Yeah, you had two really good things happen. The accrued liability went from 140 million, 49 million, 150 down to 127. So that was the change. And then the assets went from 100 to 122. So those two things working together really shrunk the gap to about nothing. Now, where we are, if assets don't recover between now and 7/1 of next year, we're going to see the unfunded get bigger again, just because of the way the markets have moved against us. Because our market value now is back down to about $110 million as of 6/30, and third quarter wasn't. I'm sorry, 110 at 6/30. Yeah. So never say never, right? But you know, and then that impact won't be felt until 7/1/2025. So that's the deferral of these actions. So you have time to plan for that with your budget. And then with respect to you know, we talked about the contributions here on the right. On your benefit side, it's like about 7 to 8 million per year is coming out, which is about 5% of the market value. So at that rate, you're on kind of the cusp of whether illiquid investments make sense or not. So where you are from that standpoint is fine, but from a liquidity, you're going to be needing to sell stuff to, you know, for the next couple of years. So maybe I'm sorry. Okay. And then, you know, let's just talk about the assumptions that we used here. Page 13 shows the yield curve. So when we started the year, this bottom line, that's where our assumption set was, and our assumption for core fixed income was 175. When rates rose dramatically as they did, we updated that to be 3.9. So a big jump in our fixed income assumptions. And that's what really drove the increase in the return assumption, why you're getting 6.6% and being above your discount rate. We're in the process of doing our final assumption, and it looks like we may squeeze another 15 or 25 basis points out of the assumption. So that 6.6 that we show you, you know, may end up being a little bit higher than that. So, which just gives you that much more buffer over your 6.5% discount rate.
You know what, every time you guys have come in from Cal, and everybody always talks about inflation being like 2.5%, like for the last 5 years. And right now it's like 7. So you really think we're gonna have 2.5% a year for the next 10 years? Yeah, okay, thank you.
Our assumption is 2.5% the next 10 years.
Thank you for the answer. Your smile, your smile says it all.
Yep.
You know, but you make a great point, Frank. If we were talking about assumptions over the next 18 months, we'd have much different assumption set, right? But you know, I'm an actuary as well by trade, so you know, I tend to take the longer term view as well. So a 10-year period is appropriate for these things, right? And all the smoothing mechanisms that Ed and his team at CAFMAC had, you know, they're designed to take out a lot of that short-term volatility, right?
You know, on page 5, you say that medical inflation has trended at CPI plus 80 basis points over the last 20 years.
Yeah. Well,
So it's a
yeah. Well,
yeah, it's a tough, and as you said, there's no hedge. So
that's right. Yeah.
You know,
Well,
it's kind of, I don't know. I don't want to, you know, so they're you know, it's, you know, you can't find a medical inflation hedge note. And I don't know if I'd want to take the credit risk of the firm who tried to sell me that either.
That's exactly right. Yeah, but we know that tips are a terrible, they're a terrible hedge, right? And so there's just some things that you have to, I mean, equities over the long term are the best, right? Or the best hedge, right? And
Yeah,
so
you gotta believe that we're gonna grow.
that's right. Yeah. And so, the factoid that we've been sharing with our clients is when we went through the first quarter and both equities and bonds were down, pretty good amounts. We went back and looked over the last 100 years and said, okay, how many times has this happened in the last 400 quarters? And the answer was about 10% of the time, 37 out of the 400. And then we said, well, how many times does that happen on an annual basis? Well, 2. So this will be the 3rd time, right? So when I say we've been through the worst of the worst, this is it, right? And so, let's rebalance, let's stick with the asset allocation, let's give the markets a chance to recover. And when we come back here again in another 2 or 3 years, let's see where we sit, right? But don't press the panic button, if you will. So I think I've taken more than 10, so I'll leave
Just
it at
keep
that.
going if you want. As long as I'm out of here, as long as I can end the meeting before 8 o'clock, I'm okay.
Got it. All right. Well, I'll leave you with this last slide. The allocations that we looked at were along the efficient frontier. And what the efficient frontier is this chart that optimizes the trade-off between portfolio risk, standard deviation, and the return. So the allocations that we looked at along that return, that frontier, and your policy is the only one that really sits above the discount rate. So if someone asks you, why you're so heavily invested in equities, you can just pull this chart out and say, this is what gets us our 6.5.
It's the only hope we have. given medical cost inflation.
Well, no,
Yeah, and Rick, just a follow-up question on the medical inflation. So the 80% spread over CPI over 20 years, what's that look like over the last 3 years, 5 years, and what do you sort of project for the next 5 to 10?
Well, let's be honest, utilization has been at 0 for the last 2.5 years, right? And so everybody is running to the hospital to get all of their stuff done that they put off, right? So I think the next 5 years it's going to be a little bit worse than the 80 basis points. When we did this study 3 years ago, the number was CPI plus $1.40. But I think the difference between last time and this time is that CPI now is a lot higher than it was 3 years ago over the last 20 years, right? So there's that spread compression is a little bit muted by the fact that CPI has probably been a little bit higher, right?
One of the reasons why we're so overweight in stocks is because this was looked at as a long-term investment that we weren't drawing money out of.
Right.
And I mean, I'm fine with the allocations we have now, but that's, I think, right, Charlie, you were there from the get-go, and that's pretty much what we decided. Right?
Yeah, exactly. That's right.
Well, and you just reminded me of a point, Frank, that I should have said right up front, was that nothing is broken. So the committee has been doing their job. When the committees do their jobs, and it makes it, for a specialist like myself, I like to see things that are broken, because then I can come in and say, these are the 3 things that you need to do, and they're real easy. But in this particular case, everyone should pat themselves on the back and say, we're doing a good job, and we're going to keep going on the road that we have.
Doing anything with us is not easy.
And Rick, it might be good to just touch on page 17 that
Sure.
forecasts the benefit payments from the actuary, just so the board is aware of what's expected kind of going forward. And obviously the city contribution will change during the next valuation period, but at least for the next few years, with the city's contribution of $2.5 million, there is going to be a negative cash flow coming out of the plan. And we are going to have to raise cash to pay those benefits.
Yeah,
And
let's see. And
Brent just interviewed for my job, so you can.
but and three of us end in 2025, so that still looks like a pretty good spot on the curve.
Yeah, so there's two colored bar charts that are sitting on top of each other. The dark blue, those are the people that are in payout. And so at some point, all the people that are retired are gonna, they're gonna pass away and die, right? And their beneficiaries are gonna die. So that's why that blue line trends toward 0. The teal line are the active people who have yet to retire. And so as those people retire and start taking their benefit payments, we'll see a little bit of a crest, and then it starts falling off. And then the third part that it's really hard to model and you can't do are your new hires, or the people that you haven't even put into the plan yet. Right? So there's another group of people that are going to sit on top of this chart. And so this chart, technically, really would never go into perpetuity if you include all the possible people. So this is just a snapshot of the 1,400 or so people that were in the plan as of 7/1/21.
Too
In
bad we
reality,
can't get the city to do more than the minimum for the next few years. This would be a good time to do it when equity valuations are cheap.
Attractive.
Yeah.
Right?
I mean, it's
Yeah.
really too bad.
I mean, in reality, I think that there'll be a time when, like the pension plan, even the drawdown in the pension plan and OPEB, where some of the stuff will just be line items for the city budget.
Mhm.
I mean, we look at the negative draw we got on the pension plan now, the regular pension plan. So,
And Frank, if you recall from the actuary's presentation, a lot of the municipalities that have these type of OPEB plans fund as they go and really don't maintain consistent contributions like Norwalk has. So they are exactly that, where there is no plan to fund these benefits. It's straight from the city's budget. So
right, and I think we were in the top 10% in Connecticut or something like that.
Yep.
Does anybody have anything else that you would like to share with us, or anybody have any other questions?
I'll just say, if you have any questions, I'm available, for any follow-up or anything like that. So if you have any questions, email, let Brett know, and we'll run down the answer for you. Okay.
Thank you. Good
Yep,
presentation.
thank you. That was an
Thank you.
excellent
Thank you all very
presentation.
much. Have a great holiday. All right.
Hey, by the
You
way,
too. Happy New Year.
because we did so well, that's because we've been guided by Britt. So you should tell all Britt's boss that he's doing a good job.
I've already done that. So
Okay.
Good.
All right. Okay.
it's a pleasure to work with. All right. Y'all take care. Thank you.
Thank
Okay,
you.
thank you.
thanks, Rick.
Is there any other discussion on the OPEB? One last thing is, in the past, because of meeting, remote, we have not gotten together at Christmas or the holidays to get together. And I will talk to the city about trying to get this meeting in person again, to discuss it with them. And if there's nothing else, I want to wish everybody a good Christmas and New Year's, and
You too.
and
Happy
then
holiday and a healthy
yep,
New Year.
happy, yep. And if you have any idea of maybe a motion for adjournment, then we'll.
Oh, I thought you were gonna say coffee at you're
Frank,
buying
we need-
coffee at Rowayton Market.
We need to raise some,
You
we
know
need
what?
to raise some
Actually,
cash for
listen,
Chitsime
if we
before
could
we
get
go.
Yeah,
together,
we're not done yet.
I mean, really, honestly, I know. First of all, Joe's not here, so we can go to late. But it would be nice to get together, actually.
Yeah,
I
it
wouldn't mind doing it, to get together one night. I don't know whether we can do it this calendar year, or maybe even plan the meeting in January that we get together. Again, I'm going to try to get us to meet in person. I don't think I'm going to have luck doing it. and I have been trying to get other, people onto the board because we are still short two. And it's really frustrating. So, but we'll try to do that in January, if that's okay with everybody.
Sure.
We should get together and we'll drag Britt up here.
Would be happy to make the trip. It's
So,
been too long.
and Chitsame, get a babysitter. So,
Actually, I'm still here. So.
okay.
All
So
right.
with that, again,
Okay.
everybody,
And Frank, we
We'll
do
do
need
the
to
new
raise
year.
cash.
Yeah,
Frank, we do need to raise cash for Chitsame in the OPEB, and we do have a
Oh, okay.
recommendation.
oh,
for
we
it.
gotta raise cash. Okay. See, she tricked us. We didn't know you were taking money out of there. Okay.
Well, we weren't making any decisions to put our cash for the last few years, were we?
Nope.
Nope.
But we were growing, and actually the performance has been quite good.
Yeah.
We kept it simple. That's a simple portfolio and
Yep.
and it's done well. So therefore, I think Britt wants to tell us where he recommends we take money and how much.
I'd be happy to. So in discussions with Chitsame, she requested, I believe, $6 million to cover the next 6 months in benefit payments. And going forward, to your point earlier, Frank, we would revisit cash needs on a quarterly basis or every 6 months as needed. And here we have the asset allocation, excuse me, that's 1031, not 430, but the asset allocation overweight to US equity. Given the strong equity returns over the past 8 to 10 years. So we suggest taking 4 from equity, 1 from core fixed income, and 1 from PIMCO. And like we did for the pension, just to try and put this in perspective with a more reasonable cash balance so that you can see the underweights and overweights. It would be a slight underweight to equity and a slight underweight to fixed income. And an overweight to cash.
Well, I mean, I don't know, taking money out of fixed income, that's something, I love that fixed income.
One day, Frank, we're going to see real yield out of fixed income. I see it
Yeah,
coming.
yeah. Let's look at what fixed income has done over the last 7 years. Anyways, though, is there anybody who would like to have a discussion on the suggestion?
I mean, it sounds, I guess we're getting into the mid ranges of the targets, but what about doing 3 on US and 1 on international equity?
I would think that's a good idea.
We're certainly comfortable with that.
Yeah.
All
Yeah,
right.
it's liquid. It's a
I
total
just feel better
market.
about US equities right now than I do international, even for the next couple of years, in fact.
Would you want to do 2 and 2?
Well, how low would that take us on, what would 2 take us down to? I'll look at
Well,
this.
you remember there's a range, so that wouldn't be,
Yeah, I know. Let's see if we
would
get
still
out. We're
be-
still in the range.
right. I mean,
Yeah.
that's,
I'm fine with 2 and 2 also.
anybody else have an idea? 2, 2, 1 and 1?
Do we need to do this now or can we do part now and part in 3 months?
I'll defer to Chitsame on.
Well, OPED doesn't meet.
Yeah, we don't meet every month. That's the thing.
Meets
about it.
quarterly.
Yeah,
That's why I said 3 months.
Yeah, I mean, that's fine. I mean, we usually pay out $1 million a month, so every, 3
do you have
million.
cash?
we'll
I'm
get it
sorry,
through the first
Do you
quarter.
have any, what is your cash again?
You
might have
got 7,000.
Yeah.
No, we still have some of the contribution for this year. It's about $1 million that we have from the employer contribution that's still available.
Okay, so we just don't want you to be short.
Yeah, let's not cut it too short here, too
Right.
close.
I mean, the thing is that do we take, then we're taking a half a million out? I mean, I'm not opposed to having it in, I would still probably think that 2, 2, 1, and 1 and just get it over with.
Yeah,
Yeah, let's
agree with that too.
just do it. Yeah.
Is that okay with you, Charlie?
I can live with it, yeah.
Then I'm not gonna ask you for a motion. I'll ask
So-
Rich.
Move to move $2 million out of US equity, 2 million out of international equity, and $1 million out of domestic fixed income and PIMCO real assets to fund cash needs for the first half of the year.
And is there a second to that?
I'll second with a note that the fixed income reduction is coming out of Prudential.
Okay,
That's right. Excellent. That's good. Any discussion? That was the discussion. All in favor? Aye. Opposed? Nope. Passes unanimous. Excellent. Thank you very much. And I appreciate that, I said goodbye to everybody already, so I don't have to do that again.
we need a
We have
motion to
slippage.
adjourn.
It is late.
Yes.
Yes, we do.
Okay.
I
Motion
move
to
that we
adjourn.
adjourn.
a
Second.
second. All in
Second.
favor?
Aye.
Aye.
Okay. And thank you for putting up with my faux pas tonight. Everybody, good night.
All
Happy
right.
holidays, everyone.
Have a
Happy
good
New Year.
holiday, everybody.
Holidays.
Merry
Happy New Year.
Merry
Bye-bye.
Christmas.
Christmas.
Happy New
Take
Year,
care.
everybody.
Go on.
Merry Christmas, happy